So CFSI, we're a nonprofit organization. We're about 8 years old. And our mission is very big, to try and transform the U.S. financial services marketplace to help underserved consumers achieve financial prosperity. Essentially, our goal is to work with all of the actors in this market, from the largest banks to small credit unions, startup fintech companies, the credit bureaus, and everyone in between, to help them deliver better, high-quality products for underserved consumers. We do that in 4 primary ways. The first is informing, or through our research, which is what we'll be focused on today. The second is through advising, and that's by working with companies in the marketplace through roundtables and consulting engagements and our conferences. The third is investing. We actually invest directly in companies. We do nonprofit grant making, and we have a related venture capital fund. And then the fourth is advocating, working with policymakers, regulators, and the DC community to support regulations that promote a healthy marketplace for these consumers. Now, before we dive into the research and the methodology and all the data, I always like to start with hearing the consumer in their own words. And in this big survey, which I'll talk about in a second, at the very end of it, we had one question where we sort of said, okay, what do you think? What was your experience like with this loan product? In your own words. And the statements were actually incredibly fascinating to read. And I just picked 5, definitely cherry-picked them, but just gives you a slice of these consumers and what they thought of their experience, right? So one says, I've had a hard time adjusting to the fact that everyday expenses, food, gas, utilities, meds, everything has gone up, right? We know this is the case, especially for these consumers. And in this economy. And yet my salary stays the same, an hourly rate that has not changed in 2 years. Due to the loan repayment terms, I was forced to continually take out another loan just to meet my basic needs. It was almost like modern day sharecropping in the form of a loan. I wish I'd never taken the first loan. Another consumer writes, my loan experience was a good one. The people were very nice to deal with, and the process was quick and easy. Fourth consumer says, these people gave me a chance when no one else would help me out, and I did not disappoint them. I paid every penny back on time as scheduled. Do not ever get a payday loan if you can help it. They are full of traps and crap. So lots of different experiences with different products for different consumers. So let's talk about the study. We call the study a complex portrait and examination of small dollar credit consumers. It's a 2-part study. This is actually just the first part, which is a quantitative survey. The goal was really here to get a big nationwide perspective on the usage of small dollar credit products, very broadly, and then to be able to do some data analysis and regression analysis of what we found. The second study, which we're actually in the midst of the analysis phase of right now, is a qualitative survey where we're really focused on hearing from the consumer and understanding their experiences and getting more specific into 3 innovative products that are newly out on the marketplace. And if we have time at the end, I can kind of give you a teaser of what we're starting to hear from that research as well. But the focus of this presentation will be on the quantitative piece. We're looking at 4 key areas sort of within both of these studies: the demographics and financial situations of these consumers, the need, why consumers need credit, what brings them to use these products, the decision process and choosing between these products, which should they use and why do they use these products versus others, and then the experience they have. Are they rolling it over? Are they using it repeatedly? Are they using it once and done? What do they think of the experience at the end? That whole suite of questions. GFK's Knowledge Panel, which is a nationally representative online panel, and it's basically a 50,000 person panel that they use a randomized address-based sampling technique to pick people that participate in the panel, and then they have to come in. It's not sort of like anyone can just join. And to ensure that people without computers or internet access participate, they will actually provide a participant with a computer and with internet access if they don't already have it, and with the training they need to participate. And they're constantly matching their survey with U.S. Census data to ensure that it's fully representative of the national population. Obviously very important for this kind of study. The study was conducted in January 2012. So essentially the data is sort of looking back a year over 2011. We're looking only at adults with less than $75,000 in household income, just to keep our focus on those that are the most financially constrained. We certainly know, though, that people with incomes above that level do use these products. At the end of the day, the full survey had 1,100, slightly over 1,100 consumers of what I'll call SDC in this presentation, with small dollar credit, which for our purposes was defined as using one of these 5 products: a payday loan, a pawn loan, deposit advance from a bank, a non-bank installment loan, or an auto title loan. in the past 12 months. And I'll define those products in a second. So at least one of them. And then they fell into the SDC group. We also had a comparison group, which we call non-SDC borrowers, or consumers for the purposes of the study. We had 500 of them, and this was sort of just for comparison, people who used more traditional credit products, right? A credit card, personal loan, even overdraft, friend or family, but who did not use any of these 5 SDC products at all in the past year. And this gives us a sense of what differences are there and what might be driving someone to use these products. So let's look at the 5 products to make sure that we're all on the same page about what these products are. First, the payday loan. This is probably the most familiar to most in this room and the most well-studied. Right? These are loans generally in the $300 to $500 range. Payment is due within 2 weeks or sort of at the next paycheck. You usually give a post-dated check to the provider, and then they deposit the check after, when the date comes due. Prices are typically $15 to $20 per 100 borrowed. That puts the effective APR at somewhere close to 400%, which is obviously incredibly high. Some also will use electronic account withdrawal for some of the online versions of these products. Pawn loans. These loans have been around for really forever in some ways. Typically smaller amount, a few $100s, secured by a physical object, TV, a chain, jewelry, something like that. Maturity is usually around 30 days. The borrowing fee is typically 20% of the loan's value. The loan's value is usually about 50% of what the product they think that they could sell the product for. Deposit advance. This is a newer product. It's certainly than the other two. These are loan advances. They're offered by banks. They're connected to a checking account, right? So usually you have to have a checking account. And if you've been a checking customer for, say, 6 months or so, you can get an advance on your paycheck transferred directly to your account and then taken directly out of your next direct deposit. These are typically charged a flat borrowing fee of $7.50 or $10 per 100. So the effective APR comes to like 350% roughly is what I've heard these days. Wells Fargo is the biggest offerer here, US Bank, Regions, Fifth Third, a few others. Yeah, so yes, what's the main difference between a payday and a deposit advance? Actually, our data gets at the kind of effective experience and the differences that consumers feel. For the purposes here for defining it, so yes, payday lenders are sort of independent, right? The corner shop or online. Deposit advances from a bank by the definitions that we're using. It's because it's a bank from whom you already have a checking account. So it's actually really easy for them to transfer the money into the checking account and then to take the withdrawal out of your next direct deposit. You have to have direct deposit with them. And they do some small amount of underwriting that usually you can only borrow up to a certain percentage of the amount you get in the last 2 direct deposits. And I mean, the fact that yes, you're getting it from a bank rather than a payday lender, I think is a huge difference for many customers. So, but let's hold that thought and we'll look at how customers are experiencing it in some of the data. Non-bank installment loans, these are offered, and we say non-bank because we're not talking about personal loans here from a bank. We're talking about loans from consumer finance companies that offer these products. These are usually larger, several hundred to several $1,000s. They're mostly in installments, can be 6 months to 2 or 3 years. The APRs can range from 20 to 30% for the large, longer loans to 200% for smaller, shorter loans. And finally, auto title loans. And this is similar to the non-bank installment loans, but it's secured by a title to the used car that you own. You provide the title, and then they'll give you a loan based on the value of the car. If you don't pay off the loan, then they'll repossess your car. Loan size is typically around $1,000, but they can range, and the borrowing fees are 10 to 25% of the loan value per month. With auto title loans, some of these can look like payday loans and can be due in about a month, and some of them are more like installment loans. In our study, it came out that most of the consumers reported their products were installment and had an average, I think it was about 12 months for the term. So that's primarily what we're talking about here. Some, though, are much shorter and much more expensive. One way that we found a similarity of answers was, or similarity of responses from our participants around these 3 products, payday, pawn, and deposit advance. And we're categorizing them as very short-term credit because they're all about 30 days or less with one lump sum payment. And then the second 2 products we're characterizing as short-term credit because they're typically in monthly installments between 6 months and a year. So you'll see in some future slides we'll use this categorization just to look at the differences between the two sections. Okay. So who are these consumers? First thing I want to point to is our estimate that based on our incidence rates that we got from the representative sample, that approximately 15 million consumers on an annual basis, or at least on 2011, have used at least one of the 5 products that we looked at. Now looking at those consumers, you'll see column 1 here. This is our main group of SEC consumers. Column 2 is our comparison group, and column 3 is the overall population. This is all below 75K in household income, though, so it's comparable. To give you a sense of how these groups compare. Let's look primarily at the first and second column. Things that stick out. Education. SDC consumers much more likely to have only a high school diploma or less than the comparison group. 60% say that's the only education that they have. Regional disparity. We see that SEC consumers are overrepresented in the South and then underrepresented in the Northeast. A lot of explanation go into why this is the case. I think it's mostly a case of supply and partially a case of demand. So you mostly have a situation where, I'm from New York, there are no payday lenders in New York because the usury cap's set at like 25%, and basically no payday lender can operate there. We do have pawn shops though. And that's true for most of the Northeast. Basically, there's no payday loans are regulated out of most Northeast, whereas there's much less restricted payday loans available, and most of these products available in the South and the Southwest, the West, and the Midwest. So I think that's part of what's going on here. I also think we have a situation where we know there are more underbanked households in the South and the Midwest in those areas, and there's more poverty in those areas. So for a variety of reasons, I think we see this area represented in greater proportion. Now, our data doesn't get down to the state level. We have a representation of all 50 states, but the sample sizes get so small that we can't make assumptions about what's happening in Washington versus Wyoming. Clearly, these products vary strongly, even state to state, even within regions, right? Even within the South, the regulations can switch. Household size, so these households are bigger, you'll see, for these consumers, so there's more mouths to feed. And then looking at the demographics of race and ethnicity, we see particularly African Americans overrepresented among users of small dollar credit. This is a consistent finding with many other studies. It's very complicated to explain why this is the case. And I'm actually intentionally not going to get into it because there's a lot of research with a lot of controversial answers about what causes that problem. And we're going to focus on other issues, but I wanted to flag it because it was a huge finding from the study. A couple other interesting findings about these consumers. Not surprising, household income, $32,000 compared to $40,000 for our comparison group. What's interesting here, they are actually using a greater variety of products. So SEC consumers use on average 2 different types of product per year compared to the non-SEC group that seems to find a product they have and stick with it. And how I would sort of think about this is I would say, this group here more than likely has a credit card, right? And you'll see down here that 61% of them do. And that pretty much serves most of their small dollar credit needs. But for consumers who don't have access to that, and these consumers only 27%, less than a third, have access to a credit card, they need a greater variety of products. So they might use overdraft occasionally and a payday loan. They might use deposit advance and an auto title loan for different purposes. In the income distribution breakdown, if we look at the blue bar here, that's SDC consumers compared to the yellow bar, which is our comparison group. Not surprising, 43% of them are in this lowest bucket here, 25K and less. What I think is maybe surprising is that 20% of the group is making above the the mean income of the United States, which is about $50,000, and between 50 and 75K. So there are consumers who are making a decent income that's still relying on these products, and that's worth acknowledging.
I guess my question is, now that you got this pretty rich data set, looked at your report, have you cross-correlated that with other sources of data to make your conclusions richer? I mean, can we, in the demographics piece where we've stopped at the moment, can we look at the political affiliation, the religious affiliation? Have we cross-tabbed that to learn more about these people and try and tease out behaviors and then solutions?
No, but we can. So I haven't looked at religion or political affiliation, which is interesting given the city we're in the last few weeks. But the nice thing about this online panel that we use is because it's a panel, we have all kinds of data on these consumers, even if we didn't ask them questions. So I'm pretty sure that we could find their political affiliation, because that's probably a question that the panel has been asked before. Now, if they haven't been asked it, I can't necessarily dig up the answer. So I would say that our focus with all of this is really about how do we identify what are the features of good products so we can get better products into the marketplace. If political affiliation might help us answer that question, then I'd be interested in it. But if it's something you're interested in for any purposes, I'd be happy to talk to you about digging out some of that data.
Black issue that you pointed out.
Yeah.
Say, okay, well, there's a church-centered society there that has a political dynamic, and focusing products on them that would be more socially productive rather than destructive in this particular topic area gives you a way into the pulpit as a way to solve that problem.
Interesting. So it's just suggesting as the sort of church could be a distribution channel or a way in to getting good products. I think that's very interesting. I don't think we've gotten to that level with this research, but I'd be happy to talk to you about it more. Yeah. Yes.
I just had another question about demographics. Did you broke it down by age group or by wealth quintiles?
We didn't have wealth information other than income. I wish we did. That would be a great question. We did have age data, and I'm trying to think. I can dig it up for you. My guess is that there wasn't a significant difference between the two groups in our study, and that's why we didn't focus on it. But I'll dig it up in the report. I believe the consumers were on average younger, which I think is what most studies have found these days. But if you follow me afterwards, I'll take a look just to find the number. Yeah. There's so much, you can just keep going, and you got to pick and choose what you're going to present. So now let's look at credit need, right? So the second bucket that we're trying to understand. We asked this question a couple different ways. One, we asked, what did you use the money for? Where you borrowed a loan, you got cash, you put it towards something. We also asked, why were you in financial trouble that month? Why were you short on funds? That's going to be the next slide. So I just wait for that one. So this is what did you use the money for? What was the credit used for? And here, this kind of looks like a lot of the research you've probably already seen. It's used primarily for recurring expenses like utility bills, living expenses, food and clothing, and paying rent. What is interesting here is to see the difference between the three bars. So the yellow is the very short-term bar. That's those products 30 days or less. And the light blue is short-term, slightly longer terms, installment payments. And the differences between them are interesting. So what we see is the yellow bars particularly stick out for these first three products. Products that are coming every month, that are recurring, that are frequent. People are finding that very short-term products are the products they use for those needs. But for a car-related, it's like a purchase or a repair, or for a home repair, a larger expense, they're using short-term products like the installment loans and the auto title loans. Now with this broader question, why did you have a fund shortage? This is where I think it's really interesting. And this is where also I think there's a need for additional research. We gave people a number of options to say, why did you have a fund shortage? And people could select multiple ones because we know there can be a combination of things that lead someone to taking out one of these loans. And you can see the different bars and the colors. What I want to break it down is in three categories. The first category is the unexpected event. This can be an expense, like your car breaking down, or you lost your jobs, your hours were cut at work, whatever it might be. This is what I think you typically hear industry saying is the main reason for these loans. Consumers get in trouble, and we're there to bail them out. For some consumers, this appears to be the case, right? They had a medical emergency, whatever happened, and they used these products. However, there's some other answers, right? So there's a group of consumers here that are saying, I had a bill or payment due before my paycheck arrived. So to me, that suggests there's some kind of cash flow problem or some kind of budgeting problem, right? They don't have enough of a savings cushion or a credit line that can tide them over for just a few days. So they had to use these products to get them through that gap. And not surprisingly, they're using very short-term products, especially because it's a very short-term gap. Then there's the most difficult situation. And these are the consumers that I think are just really in trouble. Those consumers who say, my general living expenses are consistently more than my income. I'm just in the red all the time. Or I spent most of my money paying off a previous loan from the other month, right? These are two situations where you're just really in a difficult situation. And besides that, I think it's useful to think about consumers in these different ways. When I show you the regression analysis that we did, we'll see something about this group particular pops out compared to all the other groups here. Any comments on this, the last two slides around credit need? Questions? Yes?
I had a bill or payment due before my paycheck arrived, very short credit. People really, really concerned about making sure that they pay their credit on time because they don't want to be dinged.
I'm sorry.
They don't want to be dinged on their
right.
FICO score.
Right. Could be. Right. It could be that.
Do we have any follow-up on that? Any clarity? Because, I mean, this can be interpreted in a lot of different ways.
Oh, absolutely. I think, so the answer is no, I don't have any more clarity. Right? I mean, that's the nature of a sort of online survey, is we have as much as people selected. Hopefully in our qualitative research, which is following this up, we're going to have we asked a ton of questions about what situation brought them to needing the loan. And that's the kind of question I think you really got to dig out from a one-on-one interview. So I hope we'll have more to get at that question.
So you can't do any correlations on the 37% that answered this way, like to find out if they're younger, like just recent college graduates?
That, yes, we could absolutely do. Sorry, yeah, to do some data correlations, we can definitely do. And I haven't done that again. We've correlated with repeat usage, and we didn't see that one stick out. We saw this other one stick out. I did not correlate that with, say, age or education. So that's really interesting. We also wanted to understand what was going on sort of contemporaneous with taking out the credit, right? One of the things we found was consumers are actually doing things beyond just taking out the loan. And in fact, they're doing a lot of things that we sort of think we should be telling them to do anyway. 40-some% of them are saying, I'm already reducing my spending in addition to taking out this loan. I know I need to do that. I'm going without certain basic needs and just not having it. Or I'm deferring or skipping paying bills in addition to taking out this loan. And I'm trying to earn more income. So I think it's just useful to know. The savings piece was one of the most interesting findings, though. We want to understand, these people, do they have savings? A lot of times we say, well, if people just had savings, they wouldn't need to use these products. And first of all, not surprising, 2/3 of consumers say they had no savings at all. But of the 1/3 who say they did have a savings or some amount in their savings, what's interesting is that more than half of them say they had it, but they chose not to use it, or they used some, right? So they didn't use all of it. More than half are not using all their savings and instead are relying on what is pretty expensive credit when using your savings would essentially be free. So why? It's a great question. What I'm about to give you is just my sort of guesses at it. I'd be interested in your thoughts. This is something we're digging deeper into in the qualitative piece. I think part of it might be that the savings are sort of structurally illiquid. Could be in a 401k or could be in a CD or something like that. But I think also there's a sort of a behavioral answer to this, that for some consumers, they've got that savings mentally allocated to a certain purpose. It might be that that's the real rainy day fund. That's when I can't get a payday loan, right? That's when I really need money immediately. Or it might be this is for my kids' college education, or this is for Christmas, or this is for, who knows. And there's a lot of reasons people will choose to save, to keep their savings untouched or only partially use it, but use the credit instead. What that suggests is that as we're thinking about the solution to the credit dilemma, pairing credit with savings might be part of the answer. And I'll come back to that in a little bit. So now we're in the purchase decision process. We want to understand, when you're deciding to buy a loan, what attributes matter most to you. We gave a whole bunch of answers, randomly ordered for each participant, and some of them clearly popped to the top, and I think it's interesting. The top three attributes that matter most to a consumer. Number one, I want to get the money fast. Number two, I want to I need to be able to qualify for this loan. And number three, I want to know exactly what I'll pay. And this was true across both the very short-term and the short-term loans. And all significantly higher than fees, which was down here at about, looks like number 8. So basically what it says to me, consumers, they need money, the need is urgent, and they need it now, and they'll take it from whoever will give it to them. which makes sense why payday loans can be so expensive, and so consumers will constantly pay it consistently. And while products that are trying to compete with payday loans, say the credit unions that are offering payday loan alternatives, struggle to compete because they have underwriting processes that can take time that these consumers don't have, and they want access to the money fast. One of the things that does pop out, though, and the differences between the two categories of products, for the short-term products, those that are installments, by definition here, the ability to pay back over multiple payments was something highly valued by consumers, which just says that they are identifying that feature of the product as something that they find valuable. Partially, it's definitional as well. I want to direct you to the last question here. We asked, all the consumers, did you comparison shop? And this is sort of within one product. Okay, you used a payday loan, but did you look at multiple payday loans? And I actually thought, I was surprised by this. 69% of consumers do not comparison shop. They want a payday loan. They know where to go. They're using it. They find the first place that'll give it to them. So there could be a lot of reasons here. It might be that there's no reason to comparison shop because these products have pretty similar pricing and structures, particularly within local markets. Or it might be that the need is just so desperate that they take the first one they can get and they don't have time to comparison shop. But again, I think that's an interesting point to think about as we're developing alternatives. So why not use other credit options, particularly the more traditional options? We asked this for a number of products, but I have here the three sort of what I would say are the most, the products that are most used by consumers who have access to them compared to these products, right? Credit card, overdraft in a banking account, or loans from friends or family. I mean, most prior research on credit shows that the first place someone goes is to get a loan from their friend and family before they even use any of the products we're looking at. But we know these consumers didn't use these products, so we asked them why not. For credit cards, number one reason why they didn't use it was, I don't qualify. So they can't access the card. So that starts to get that question you were asking earlier. And I think that is a big reason of why people are using these products. Their credit score is just too low. They don't have a credit file at all to begin with. The credit score has been damaged by the foreclosure. Who knows? Then there's a group that says I maxed it out or I can no longer use the product. And then there's a group that says the credit cards are too expensive, which is really interesting because we know that credit cards are dramatically cheaper, at least on the face value from a payday loan. Again, this is going to be just my speculation here, what the case is. I think if you're getting multiple late fees on your credit card, it can be too expensive. If you have a subprime card where you have to put all kinds of money up front, which they're really not in the market anymore, but that could be expensive. Or it could be that someone confuses 15% APR with 15 per 100 borrowed and just doesn't actually understand the differences. Yeah.
Which is the minimum payment, which is much lower than the payday loan. If it gets higher than the payday loan, then
right.
That's what
no, we didn't ask that, but that'd be interesting. I think there's a lot more to figure out about the credit card piece. On the overdraft, why didn't they use overdraft? The number one answer, it's too expensive, and that makes a lot of sense. If you think that a lot of these loans are small, a $36 fee that then gets taken out of your next deposit, or $32, whatever the average is these days. If you think about that if you only wanted to borrow $100, or if it was only on a $50 debit card swipe, that's going to be a very expensive product. And I think these are rational reasons of why a consumer wouldn't use overdraft, or that it's too inconvenient. That having the fees at the end of the day, we know a lot of consumers don't like that about overdraft. Or this also could be interpreted as I don't have a bank account, all right? So it's just that makes overdraft inconvenient, or I don't qualify for it. Again, sort of the same. And then for loans from friends and family, the first thing we see is a lot of people are saying, I did use this in addition to taking out this credit product. And then consumers will say, well, or I found it too inconvenient. And we hear a lot that borrowing from friends and family can be very complicated. I think that's quite obvious. Or there just wasn't an option to me. I didn't have a rich grandmother to talk to, or not even rich, but someone who had a few $100. So now we'll go into the experience and what happens when consumers use these loans. The way we framed it was a single loan experience, so sort of from the taking out of a loan to the conclusion of that loan, which could be default or paying it off after multiple rollovers or refinances. So that's what we're going to define here as a single loan experience. We'll look across the whole year in just a second. For the payday product, the question we asked just to understand the question of repeat usage and rollovers was, did you pay off your first loan on time? Here we see 62% of consumers saying yes, paid it off on time, so essentially at the end of 2 weeks. And then 38% said no, I did not. Of these, the vast majority of them end up in rollover, and a small percentage end up in default. For those that end up in rollover, the average number of rollovers is 5. Now, this is just one experience, so we're going to show you another way to think about this question in a second. For pawn loans, it's slightly less, 55% saying they're paying the loan off on time, 45% saying they didn't. Again, a small percentage of them defaulting and, in this case, losing whatever they had pawned. The average number of extensions is about 2.5. This is almost equivalent because most extensions are closer to 30 days, so you can almost look at these things as equivalent. And then on the deposit advance product, it was hard to get at the question of repeat usage or rollover because you can't roll over a deposit advance. It's just taken automatically out of your next paycheck because they have access to it because it's from the bank where you have direct deposit. So what happens is if for some reason that direct deposit doesn't come in, if you were to cancel it or if your paycheck were to be cut, basically like usually 35 days later, they'll actually just withdraw the amount from your account. And if it's not there, then you could end up in an overdraft situation and then paying an overdraft fee. And so that was the question we asked here. Were you able to pay it off without overdrafting your account? Here we saw 85% say yes, 15% say no. But again, I wouldn't think about this as being qualitatively different because of the structure of the product. When we wanted to get at this question of repeat usage, we asked, did you take out another advance in the next month? And this is a concern a lot of advocates have raised, said, okay, they take out deposit advance, they're taking out repeat, right? They take it out, then they're short the next month, they got to take it again. So it could in some ways be no different than payday, which is the question someone asked earlier. And here we see over a third saying they took out another advance that next month after taking out the advance we were talking to them about. Looking across the entire year now, we sort of compiled different answers from the survey to get at, well, how many loans are they using across the year if we think of a rollover as a loan. And here we got, for payday, about 11 loans per year. This is actually higher than a lot of other surveys have seen. I know the Pew Research Center and CRL, the Center for Responsible Lending, I think they look at about 8 is the average number of loans nationally. It can vary extremely across different states, which basically means some of these people are on debt an average of 150 days per year. Pawn, the number was 7, and that puts them in about 200 days per year. And then looking at short-term credit consumers, for installment loans, and now these are different, right? These are over multiple months, so sort of defaulting happens in a different way. Did you pay off the loan by the end of the original term? 76% say yes, basically 3/4. About a quarter say no, I didn't pay it off at the end of the original term. Some of them default, most of them refinance, an average number of about 3 times. Auto title loans look somewhat similar, slightly less than 3/4 say yes, I paid it off on time. Slightly more say than 1/4 say no, I did not. And those that refinance, average refinance is about 3 times. Now, of course, in this case, if you default, you're likely to actually end up using your car. So any questions on the sort of the experience and the rollover question? Yeah.
Do you know if the installment loans require a bank account too?
The installment, that's a great question. My guess is they probably do, but I don't know. Yeah, sorry. Yes? So in this, it's really tricky because these products really vary by state. So for our survey, the average consumer reported a term of 12 months on average. So, but now it varied. Well, a refi doesn't necessarily mean you're extending it for a whole other year, right? It could be you're just getting extra cash out and then extending it for another 6 months. Some people said they're refinancing because they were struggling to pay it back, and some people say they're refinancing just to get more money.
I guess you showed us about 150. Sorry, you showed us about 150 days of debt for payday and 200 for
payday,
pawn
yeah.
shop. I guess I'm wondering how installment compares.
Yeah, it's tricky to look at installment, right? Because I mean, if you have a year-long loan, you're technically in debt for a year. I mean, like if you have a credit card, you could be in debt for all the time while you have a credit card out, right? If you're constantly maintaining some kind of balance. So the question of how many days a year are you in debt is trickier with longer term or open lines of credit.
I mean, what can we get from looking at shorter term credit then?
Well, I think the short term, it's a great question. I think the short term credit, the reason and it's useful to look at how many times they're using it per year is because it's theoretically not designed that way. It's theoretically designed to be a very short-term loan, to be a 2-week loan. But if people are really using it for a third of the year, then you have to ask yourself, is it actually long-term credit with an incredibly high interest rate? We had an academic from Princeton look at some of this data for us and do some regression analysis, try to find what are the variables that lead to repeat usage, right? That was the key question we were focusing on. And 2 things popped out to us. One was the ratio of loan size to income, or essentially debt to income, DTI, right? It wasn't about just the amount of the loan, and it wasn't just about those with low income. But if as that loan size to income ratio went up, we saw a direct correlation to the number of payday rollovers that the consumers were likely to have. That strikes me as pretty obvious, right? And payday doesn't really do a lot of underwriting for income, so the fact that this exists makes sense. It also suggests how we could potentially improve the situation if they did underwrite for income or for ability to repay. What I think is more interesting now, if we remember back to that slide that I showed about funds shortage, one of the answers was my expenses are consistently higher than my income. And we tested all of those answers against repeat usage, and only this one demonstrated a positive correlation between rollover, or essentially the equivalent, for 4 of the 5 products we were studying. Payday, pawn, auto title, and deposit advance. In some cases, very strong. And the numbers and some of the p-values and stuff are all in the paper if you're interested in that stuff. But what this suggests to me is that for these consumers that are just consistently in trouble, it's not clear they should be getting a loan in the first place, right? That this loan is just going to be difficult for them to pay off. They're the ones that are going to end up with the 12 rollovers, the 20 rollover. Their constant repeat usage, constant refinancing, constant usage of deposit advance. And it's possible if we could find ways to better identify these consumers before through better underwriting, or we could potentially keep them out of products that they are likely to essentially fail at using. What the solutions are for these consumers who are struggling and who do need a loan to get through that month, that's a harder question for all of us to figure out. Yeah?
Who is the we that is underwriting? It's not the industry's interest that these consumers getting loans.
That's right. No, I wouldn't. I think that's an oversimplification to say it's not right. For the payday product, we certainly see that they make something like 80% of their loans, and essentially 80% of their revenue comes from like 20% of their customers who are these high rollovers. It can be less the case for the installment, the auto title lenders. I think. So look, I mean, if underwriting and taking some of these people out of your loan pool means your business model doesn't work, then I think there's a problem with your business model, right? But if we can, to figure out business model solutions that can help those people who are able to pay credit, get the credit, and still be a profitable company, that's where at least CFSI would like the market to get to. And then I think, so the we can be a lot of people, right? The we can be the providers. The we can also be regulators and policymakers and researchers who are trying to understand this question and testing out different interventions, testing out different type of underwriting models, and thinking about what are the kind of credit products we think should be on the market and what products shouldn't. And how do we, for examining a credit product or examining a bank, whatever it is, think about their underwriting system and whether or not it is, leading to the situation or preventing the situation. Yeah.
If you make a type of loan illegal, aren't you just taking a pretty big chance that people will just get illegal loans?
So that's a really tough question. There's a lot of different research on that. Sort of what happens when you ban a product, like ban payday, and that's complicated and hard to say. And that's not sort of where we're focused. I think what I'm suggesting here is not banning one product or another, but thinking about the features of the product and how those features could be improved, right? So what would it mean if it's not? I'm not saying like, payday is not going to reform their practices. I don't think they're ever going to start underwriting, the way that a credit card is underwritten. And if they would, that'd be fantastic. And there are some new innovators in the market. There are some new online lenders and some new startup companies that are trying to do advanced forms of underwriting. And I can talk about those a little bit at the end. What happens when you ban a product? there's a lot of different research out there. Consumers seem to find a way to get the money. Some do probably end up in less than in even more predatory situations like a loan shark. Some will just make budget cuts. Some will just go to the uncle that they didn't want to go to in the first place. The Pew Research Center did a study where they looked at consumers in states where payday had recently been banned, and they saw that only 5% of them were going to online payday, which some people have suggested is just where everyone would go when you ban payday in your state, because online payday, if it's based in like a tribal territory or offshore, you could actually get anywhere. It's really hard to regulate, but we haven't seen that be the case. So I don't know the answer to that question. People will still need the money. How they find to make that budget work out, I think people will find a lot of different ways to do it. So we're getting close to the end, and let's just the final section is sort of on the consumer experience. We asked a basic customer satisfaction question: how satisfied were you with the loan? And there's a couple of interesting things that come out of this graph. The first is that a lot of these consumers are pretty happy with these products. Giving it a 5 or a 4 on a scale of 1 to 5, 5 being very satisfied. In fact, almost all these products, a majority of consumers say they were satisfied with the product. Now, what does that mean? Could mean lots of things. A lot of the qualitative research on these products has showed consumers really value the fact that someone's giving them a loan because they don't think they can get a loan anywhere else. And that's probably true for many of them. They really like the customer service. The tellers at the stores are friendly. They speak their language. They're from their community. I think a lot of that goes into some of these scores. We also see, even given all that, a strong group, especially amongst payday and auto title loan, about 20% saying, very, very unsatisfied or unsatisfied with their experience. To digging a little deeper into this question, we asked about fairness. How fair did you consider the terms of your loan? Here the average is around 3.5, but we see a big difference when we look again at payday and auto title. So these two products have, these are actually statistically significant differences in the fairness of the terms of their loan, rating them at the lowest amount. We also see 40% and 43% saying the loan cost more than I expected it would cost. And this, I think, is a big piece of the conundrum, is that people are overconfident that they're going to be able to pay it off, and they don't realize how likely it is they're going to end up in that repeat usage situation where the fees start racking up. And then also nearly a third saying it took me more time than I expected to pay off a loan. And they're obviously related. And finally, we asked, would you use this product again? And here we see the lowest marks, again, for payday and auto title, 33 and 22% saying they would without hesitation. A bunch of those saying, the plurality saying, look, if I have no better options, I will use this product again. And then finally, getting back to the earlier question about deposit advance, at least among these 5 products, deposit advance did get the highest scores across the board. The highest ratings on fairness, the lowest ratings on costing more than expected or taking more of the time than I thought it would take, and the only one that had a majority of people saying I would use this product again without hesitation. So now I'm going to give some conclusions from the research, and then we'll take any questions you want for the rest of the time. The first is that, looking at all these products, and we recognize that in some ways this is a mile wide but only a few inches deep kind of survey, and that was the purpose, right? To get a big picture understanding of these consumers. It's very clear to us that consumers have lots of different needs, and we saw it in the study, and they're using different products for different purposes at different times in their lives. And this suggests that there are a need for a lot of different kinds of products for these consumers. But these products need to be safe, they need to be affordable, they need to be high quality, and they need to be designed in different ways to meet these needs. There can be a role for those very short-term products and for the short-term products that get paid out over months. There can be a role for secured products like pawn and auto title, and a role for unsecured products like some of the other ones we looked at. And the consumers will find ways to use these products to meet the needs that are right for them. That said, for some consumers, it's clear that the best long-term solution may not involve credit at all. And that we're going to have to think about other solutions, whether that's government support, whether it's financial literacy, whatever it might be. But that for some consumers, credit probably is just going to do more harm than good. As we're thinking about better solutions, there's going to be a balancing act. We're going to have to balance making the loan affordable with good underwriting, but also making the loan easily accessible, quickly available, and convenient to the consumer. These things are in tension. Underwriting takes time. Underwriting takes cost. We also think credit can play a role alongside savings. There's a lot of interesting products in the marketplace that are talking about ways to combine savings with credit. So possibly a part of the loan disbursement goes into a savings account. Or after you finish paying off the loan, you just continue making payments and that money goes into a savings account. If people have questions, I can talk about a few more innovators in that space. But I think there's a real key there to getting people out of this trap is when they need credit, helping them to build savings so that later they have that cushion for themselves. Or that savings can be used as a security to then decrease the cost of the loan when they want to use it if they don't want to touch their savings, which we know some consumers don't. And then the question of underwriting, right? That this is just going to be key. Looking at a consumer's ability to repay, understanding their full financial situation there, in both sides of the balance sheet is going to be critical to preventing those consumers that are going to get into the situation of repeat usage. And then as we're all working in this marketplace, there's going to be a balancing act. That we're going to need strong consumer protections, but we're also going to need to find ways to promote innovation in high-quality credit so if we're going to fully address the struggles and needs of small dollar credit consumers.
So I've done a lot of work on refund anticipation loans, which is one of the high-cost small dollar credit products that aren't in your list.
Yeah.
And the patterns there are really interesting because they've essentially been regulated out of the market now. And so we can look at what consumers are opting to do in light of not having access to refund anticipation loans. And the answer, which is not surprising to most of you, is they're using refund anticipation checks. And so I think there are really interesting questions when we look at these other small dollar products about what alternative consumers are turning to. But certainly, I think those still merit attention. 1 in 5, 1 in 6 tax filers is using those every year. So that's part, but it also kind of is illustrative of what is happening with these other products.
Yeah, we just actually put out a separate study sizing the market, the amount that underbanked consumers spend for financial services in 2011, and the number was $78 billion in fees and interest, of which I think 80% of that goes to credit. So the vast majority of going to credit. And one of the trends that we identified was basically as RALs was on the way up, RALs on the way down, RACs on the way up.
Fairly valueless from that proposition. And interestingly, there's a fair amount of RAC use from self-prepared filers. Almost half, maybe now a third, of RAC use is among self-prepared people. So people that are using TurboTax are opting not to use a credit card. Most of them have one, and there's a lot of questions now about why, and I think part of the reason is people just aren't understanding or appreciating what they're doing.
Yeah, and just so everyone understands what RACs and RALs are, some people eyes glazing over. The RAL, the refund anticipation loan, check me if I'm wrong, was basically, if you were getting your taxes prepared and they said, you're going to get $3,000 in return, you could, that the tax preparer would actually give you the money now. And would take that amount out. That was essentially the cost of the loan until then your money actually came in 2 weeks later. It would come into them, right? So that's now basically regulated out of the market, and the effective APR on those products was very high, like in the payday category. The RACs are, essentially if you don't have the money to pay for your tax preparation service, which can cost $100, then they'll essentially front you that $100. And then for, say, a $25 cost, or $35 I think is maybe the average, which they'll take out of your return when it comes in. So if loan preparation costs $100, then 2 weeks from now when your return comes in, they're going to take out $100 for loan preparation and $25 for for giving you that 2-week leniency on that $100 fee. So anyway, it's basically entirely replaced RALs now. The market finds ways, or consumers do. Yeah, other questions? People who haven't asked a question, there's some people who haven't raised their hand yet, and I want to hear from you. All right, gentleman in the front, you had a question?
Cultural era here from 1940 on, when we changed from dominantly agriculture to an industrial society where these products began to be affected by urbanization and phenomena of the modern era. What's happened to this product line? How did it evolve? Where did it start,
Yeah.
and where are we today?
So I'm not a sort of historian of these products, so I don't know the exact answer. There's probably people in this room that do. I can give you a little history of the 5 products just to give you a sense, because I think it's interesting. Payday is gotten to scale in only about the last 30 years, right? And it's been huge. Although it's actually storefront paydays on the decline in the last 2 years, internet payday on the incline. Pawn has existed since like the Bible. And there are like laws against pawn lending. It's actually really interesting. I did some research on this. You couldn't lend. The Bible said very clearly you couldn't lend to someone, or you couldn't pawn. Someone could not pawn the shirt on their back or the instrument they used for their work, because you could be preventing them from their livelihood or from staying warm at night. So pawn goes way back. Deposit advance is more like the last 10 or 15 years. Since Wells Fargo put their product, they were the first big player in the market. Installment lending's been around for a while, although the consumer finance company, I think that's also a last 10 or 20 years kind of thing. Auto title lending, I don't know as much about the history of that. So most of them are actually fairly new with the exception of Pawn, at least in the size and the scale that they're in the marketplace now. How it correlates to changes in the economy is really interesting, but I'd be just speculating.
So this is sort of an interaction of a couple of tables that you presented on the reason for why people took out a short-term loan. Do you know what particular type of product they were using? Because you were talking about the most recent type of small dollar credit you used, right? Do you know, like for instance, if they used a deposit advance versus a payday loan when they had this circumstance?
Yes.
Okay.
So we broke it down there just between the very short term and the short term.
Right.
But we can break it down by individual product.
Okay, so you would know, for example, the last time you got a payday loan, it was because you had a bill or payment or something like that.
Yeah,
Okay.
exactly.
All right, so then part 2 of the question was thinking about the satisfaction measures and sort of the difference in the profile of satisfaction of people who use payday versus deposit advance. And thinking about your little categorization scale of how dire these circumstances are. Is there a difference in sort of how dire the circumstance was?
Right, so and to sort of correlate, right?
Right.
The question of the circumstance versus their experience in the end.
Right.
We could definitely do that.
Sort of, are you under duress
Yeah.
more, and would that impair judgment and decision making, or you just feel like you're being taken advantage of, that kind of thing?
Right. My guess is you would see yes, but I'm not. I'd have to go back and take a look at it. Yeah, there's so much more analysis of this data that we plan to do. We are going to have at least 2 more dives into specific areas of the research. One is going to look at the differences between those 5 products, which someone asked about earlier, more specifically, who's using Pawn versus Payday. And one's going to look specifically at the question of the credit cards and overdraft and trying to understand why people are choosing those products versus these products. So we're trying some more. There'll be some additional analysis, and we're always happy to have any researchers who want to participate and have access to the data set that are interested in looking at it or correlating with stuff that you've done. We're not making it public use yet. We're considering it, but if you wanted to partner with us and sort of agree to sort of share some data together, that's sort of how we're approaching it right now. Sorry, no. So I didn't mean to misspeak. If someone's interested in talking to us about accessing the data, then we're interested in sharing it. But I don't think we're putting it on the internet just yet. Oh, okay. So I don't know the exact regulations and how it works for us. Obviously, there's a lot of data, and we also have we also work with a lot of industry on this, and so we're sort of sensitive to some of our data and how we use it and what's the most effective way for us. Because we're also trying to talk to industry, right? And we want to help them design better products. And we've shared a few of the data points with industry who want to benchmark their product against our product and against our overall product of the industry and see where are they doing well and where are they not and how can they improve themselves, which has been really interesting. I think I'll sort of close with just to sort of, well, are there any last questions actually? Oh, yeah, Carlos. Great.
Okay. First, you said that there is a quite big ratio of individuals with a high income which use these products. You said, I think I remember it was 20%.
Yeah.
The question was why? Why do they use them? And also, are they banked? Do they have access to credit card and bank services?
I haven't done a slice of the data of just those customers, so that's a good question. So are you supposing? What do you think it is?
What my thinking is?
Yeah.
Well, no, I don't know. Well, this is a good question because, according also to the financial capability study, we have found very high percentages of users also with income higher than $65,000. So, and this is of course a big question, and I don't ever.
Most studies will show that people in higher incomes are less likely to be underbanked, right, and are more likely to have better credit scores and more access to products. So my guess is that would be true here. I think what's interesting is, why do those consumers in that situation use these products, right? I mean, we know that there are a lot of people with decent incomes that got into the foreclosure trouble, and so that might be that their credit score is now ruined, right? Or they've maxed out their credit card, or whatever it might be. We also know that some people use these products because they're kind of out of the system, and for whatever reasons, they sort of want cash that's kind of not going to be tracked in a certain way. Some could be nefarious, and some could just be they like staying away from the credit bureaus or whatever it might be.
Do you study or track situations where people will buy from sources that provide low quality materials at high prices, but the reason people will buy it is because they'll get easy credit?
What would be an example? Like
well,
an auto loan?
Actually, I don't know. I would say years and years and years ago when I was young, we used to have a man that came around in the community, and if you wanted something, you could tell him, I want to buy a sofa. He would find you a sofa, and he would sell it to you on credit. He would charge you a whole lot more for that sofa than somebody else would charge you for that sofa, but you would buy it from him because he'd give you credit. Now, I don't know. I was under the impression that some kinds of catalog sales were sort of that way too, where they're really not a very good buy, but people are buying from them because they give out easy credit. I don't know for a fact that that still exists, but I expect it probably does.
Yeah, I mean, I would expect it does exist in local markets. I haven't seen any in some of this research. And one of the things that we're looking at a lot now is auto lending and the whole buy here, pay here section of the subprime auto market, where people who can't get a loan from a bank or credit union or even from a subprime lender go to these sort of buy here, pay here shops, where it's possible that you're getting a car that's not of good value or that's being overpriced, and then you're getting a loan that's 20 to 25% APR, which is incredibly high for a secured loan, which is an auto loan, and the default rates are like 25%. I mean, they essentially know that a huge chunk of people are going.
Turning what are balloon loans into truly more installment loans. If I borrow $300 on a payday loan, it automatically puts me $300 behind the next month. But if I only had to pay $50 this month and $50 the following month, I might actually not have to roll over that loan. And so, I mean, can you talk about some of the innovations you're seeing in this market space?
Yeah, there's a few out there that are interesting. One that's actually playing with that transition from balloon to installments, a new company called LendUp, based in California. Check them out, lendup.com. And they offer what is essentially a payday loan. I think you can get up to 28 days to pay it off. It's a lump sum installment. But if you pay it off successfully on time, the next time you take a loan with them, you can get an installment loan instead and have 6 to 9 months to pay it off. And it's assuming like we're talking about someone here with a credit score that wouldn't be able to get an installment loan or wouldn't be able to get a credit card. So they're using just their internal systems to then make you eligible for a longer-term product, and which then they can start reporting. One of the problems with getting people off of the very short-term products with those balloon payments, those lump sum payments, is that most of those products aren't reported to the credit bureaus. So even if you pay off your payday loan successfully the first time without rolling it over, that positive payment doesn't go into the bureau and then improve your credit score for the most part. But if you end up in collections, that probably does. I mean, the question of credit bureaus, credit scoring, alternative credit data is a piece of this that we didn't even get into. It's actually another research project CFSI is working on. Maybe I'll get a chance to come back and talk to you about it to understand that's a whole piece of the system which feeds into this. Another interesting point around innovation, Regions, which is one of the banks based out of Alabama that offers deposit advance. They're part of our qualitative study. We'll be looking at their consumers. They offer deposit advance, which is essentially, it's due, comes out of your next paycheck, but they offer you the option to do an installment. And you can switch to installment instead of having it all come out in one lump sum. And I think then it's over 3 months, and they take it off in chunks from your deposits. Only 15% of their consumers elect to take the installment. So now you have to ask yourself, well, why is that case? That's the question we're going to be getting at in our study that we'll hopefully have a very good answer to. My guess around that question is that consumers, A, don't want this loan on their back. They kind of want to be debt-free. They think they're going to pay it all off. But some consumers are realizing that there's value in installments. So stay tuned for sort of a better answer to that question than just my guess. Some other, I think, interesting, just generally to say, okay, largely I'm saying there's this gap in the marketplace, and that we want to see more high-quality innovation so that consumers don't have to rely on a lot of the products that we studied here. But I think there are some good products out there that show promise. They're not 100% great. We don't, there's a lot of research that needs to be done to define what a high-quality loan is. It's a question CFSI is deeply trying to understand. One example of a company that I think is really fantastic is Progresso Financiero, or Progress Financial. Has anybody heard of them? Okay, a few heads. So they're based out of California and Texas. They just expanded to Chicago. They're focused on Latino consumers. Their product, hence Progresso Financiero, the product is almost entirely offered in Spanish, sold in Latino supermarkets with sort of tables, essentially, little mini offices, sort of the way you see mini banks and supermarkets. There'll be a little mini Progresso Financiero office in a supermarket in a Latino neighborhood, serving consumers. For many in these cases have thin or no credit files in the bureaus, or might have subprime scores and wouldn't get a loan somewhere else. And they offer a loan product. I think the average loan price is around 24%. It can go as high as 36%. They're installment loans. The average time is about 9 months. The average loan size is about $1,000. They do report to the credit bureaus. They do decrease the price or increase the loan amount for the subsequent loans if you paid them off on time. And they, unlike almost any of the innovators in the small dollar credit space, are turning profitable supposedly in the next couple of months. So they've found a way to make a business model with a product that, while having a high interest rate, compared to a lot of the alternatives these consumers would be, is I would say, a dramatically improved product. I should also say, full disclosure, the venture capital fund that CFSI is associated with has invested in Progresso Financiero. So you can judge my endorsement of them by that, but also we put our money where our mouth is, and we're trying to support good companies in the marketplace. LendUp was a company I mentioned as a company called Neo Loans, which is actually an auto lending company. So getting back to the car question, what they do is they have you. They're trying to be a competitor to the Buy Here, Pay Here product that I was talking about, and they have you You have to provide them access to your bank account, but not so that they can take money in and out of it, so that they can look at your past 3 months of transactions, and they assess your income and your expenses, which is one of the components we identified here. And then through that and other underwriting they do, and credit checking, et cetera, they'll then, for a group of them that they deem creditworthy, will give you a loan at more like a traditional car loan price of I think it's 12% APR, which is still high, but again, half the price of Buy Here, Pay Here that you'd otherwise be getting. So that's sort of their technological way of doing underwriting and trying to help some consumers who are creditworthy but just aren't seen by the current credit system. There's a lot of other innovations out there. If they're interested in that question, our conference, the Underbanked Financial Services Forum, happens every year, and we highlight the companies that are doing this kind of work. It'll be in Miami this year, June 5th to 7th. I think the question of the state-by-state regulatory nature of these products is really interesting and is really difficult. There's a bill in Congress right now, the Non-Bank Federal Charter Act, that a lot of, particularly the payday industry, is to support to enable those companies to be able to offer products nationwide and have a federal charter. We don't have yet a position on that bill. I think it's complicated. The thing I will say is that the question of the state-by-state nature of the market does complicate things, right? There are, I think, good actors out there who are offering products and have to get licensed in every single state. And that makes scalability really hard. And if we want to bring the price down, one of the ways to do that is through scale. So now we don't want to enable bad actors to get predatory products nationwide and usurp strong state laws where they exist. So how do we craft the regulations that create that balance, right? That allow good actors to scale up and hold back the low quality products from flooding the market? I do not know the answer to that question. I hope some of the people in this room are working on that one. Okay. Great. Well, thank you all very much. I really appreciate this. I hope you'll hang out at the reception. We can get a drink together.